I would now like to review exercise 18-23. And in 18-23, they give us the paid-in capital section of the stockholders' equity as well as the retained earnings. And what I want to point out to you is the treasury stock is when a company repurchases their own stock, their common stock, and it is issued stock, but it's not outstanding. Treasury stock does not receive any dividends, and it is used to reduce, it is a debit, and of course a debit would reduce any equity account. Now, during 2021, several events and transactions occurred. So I'm going to go through each of these because there's different ways to handle some of these transactions. On March 3rd, the board of directors declared a property dividend of 240,000 shares of Lisco International common stock that Consolidated purchased in January as an investment. They paid the book value. At that time would have been the fair value, but it's the book value when they purchased it in January of $700,000. But when they gave it as a property dividend, the investment share value was $3. So we would take the $3 times the 240,000 shares. So at that time, the fair value at date of declaration was $720,000. The first thing we have to do is debit the investment to bring it to its fair value of it will bring it to its fair value of $720,000 because we're debiting it for $200,000 and we're crediting a gain on investment for $20,000, which takes the book value, originally the amount they paid, of $700,000 plus the gain, which increased the investment in the equity security of $20,000. So then we can actually record the property dividends payable. And we know that when dividends are paid, cash dividends or property dividends, we would debit retained earnings for the 240 times the fair value at date of declaration for $720 and a credit to property dividends payable for $720. March 15th is the date of record, and the date of record is if you own the stock as of the date of record, you will be paid the dividend. If you did not own the stock till after date of record, you do not qualify for the dividend. So when the stock is actually distributed, the company on March 31st, the payment date, when they would debit the property dividends payable and credit investment in equity security for the $720,000. The second journal entry, B, on May 3rd, a 5-for-4 stock split was declared and distributed. The stock split was effected in the form of 25% stock dividend. The market value of the $1 par value stock was $11. For any stock distribution for the company's own stock, any distribution 25% or greater will be debited at its par value to the account paid in capital in excess of par or retained earnings. So in this case, if you took 25% times the 360,000 shares outstanding, the reason there's 360 shares outstanding is because in the information in the problem, as far as when you review the paid-in capital, we are told that the common stock has 364,000 shares outstanding, of which, when you look at treasury stock, is $4,000. 4,000 common shares. So there are 360,000 shares outstanding. The treasury stock, which is the company owns their own stock, will not receive a dividend. Whether it's a large dividend, a small dividend, or a cash dividend, or property dividend. So they would debit paid-in capital in excess of par for $90,000 and a credit to common stock for 25% of $360,000, which is $90,000 times the dollar par, which is there's a credit for $90,000. So just to point this out to you, the total stock after the stock dividend is $450,000. Prior to the stock dividend, it was $360,000, and that gives you the 90,000 additional shares issued as the result of this large stock dividend. It is considered a large stock dividend because it's 25% or greater than the stock outstanding. And when a company has a large stock dividend, they would debit the paid-in capital or retained earnings for the par value. In this case, it would be the 90,000 additional shares times the dollar par value. Now in C, we're going to see that we had a small stock dividend because it's less than 25%. So in C, on July 5th, a 2% stock dividend was declared and distributed. The market value of the common stock was $11 per share. Because it's a small stock dividend, they would use the actual market value of the common stock when the dividend was declared. So in this case, we would have to take 450,000 total shares common stock shares outstanding times 2%, which is 9,000 shares. So the retained earnings would be debited for 9,000 times $11 per share, which is $99,000. And the common stock would be 9,000 shares times $1, which is $9,000, and the paid-in capital in excess of par would be 90,000. This is a small stock dividend, and they actually use the market value of the shares on date of declaration. On December 1st, the Board of Directors declared an 8.8% cash dividend on 90,000 preferred share payable on December 28th to shareholders on record December 20th. So on the date of declaration, they would take the $90,000 times the 8.8%, and they would debit retained earnings for $7,920 and credit the cash dividends payable for $7,920. On date of record, it's just a memo journal entry. There is no journal entry. They're just formally recording who has to own the stock to receive this dividend, and you have to own the stock on December 20th to receive the dividend. And then the payment date would just be a debit to the cash dividends payable and a credit to cash. Now, on December 1st, the Board of Directors declared a cash dividend of 50 cents per share on its common shares payable on December 28th to shareholders of record on December 20th. Well, we know that right after the large stock dividend, we had 450,000 shares outstanding, and then in journal entry C, we had a small stock dividend, which resulted in an additional 9,000 shares outstanding. So 450 plus the 9,000. So they would debit retained earnings for 459,000 times 50 cents, which is 229,500, and credit cash dividends payable for the $229,500. Date of record, it's just a memo journal entry. And then on December 28th, they will actually make the payment. So that would be a debit to cash dividends payable and a credit to cash for the same amount.